Welcome everyone. Today we'll be looking at another trading strategy known as hedging. Hedging is a risk management strategy that is used to offset losses by taking an opposite position. The two positions should both remain open without cancelling each other out, and they can be established just before the release of a key news event. Hedging against risk means using financial instruments or market strategies to offset the risk of any adverse price movements. In other words, investors hedge one investment by making another trade in an opposite direction. The reduction in risk provided by hedging usually means a reduction in potential profits. Basically, hedging is a technique that is meant to reduce a potential loss and not maximize a potential gain. If the trade you are hedging against is profitable, you also usually reduce your potential profit. However, if the trade loses money and your hedge was successful, you will have reduced your loss. Bear in mind though that every hedging strategy has a cost associated with it. So, before you decide to use hedging, you should consider if the potential benefits justify the expense. It's important to remember that the goal of hedging isn't to make money. The purpose of hedging is to protect from losses. The main advantage of hedging is that the neutral position is resistant to sharp market swings that generally take place after a significant market event occurs. Thank you for watching. Hope you found our video interesting. In our next video, we'll be looking at another trading strategy.
Hello everyone, my name is Emily. In today's video, we are going to talk about the scalping strategy. Scalping is a forex trading strategy that involves opening and closing multiple positions on one or more forex pairs over the course of a day, usually in seconds or minutes. Instead of opening one position at the start of a trend and closing it at the end, scalpers will open and close several positions over the course of a trend. Scalpers usually hold a position for a very short time, getting in and out of a trade within minutes if not seconds. The aim of scalping is to gain just a few pips at a time, looking for multiple small gains rather than fewer larger ones. Scalpers often use CFDs to trade forex pairs that are rising or falling in value. They will open a position to buy if they think the price will rise and open a position to sell if they think the price will fall. The short intervals between trades and the speed of the scalper working with price differentials enables trades to have less exposure to risk overall. In addition, if the trader is very disciplined about cutting their losses on losing trades, their risk is reduced even further. CFDs, which are leveraged products, also enable traders to open a position with a deposit called a margin. This can magnify profits but can just as easily magnify losses because your profit or loss are calculated from the full value of the position. That is why it's so important to have an appropriate risk management strategy in place no matter which scalping techniques you're using. Basically, in order for a scalper to make a significant amount of profit, a larger position size is usually required to make the trade worthwhile. But scalpers must be very careful to avoid high volatility when trading in the forex market and to have a reliable broker that offers minimal recalls. Thank you so much for watching us today, guys. Stay tuned for more educational videos. Bye-bye!
Good afternoon. How is everyone doing today? Hey, Godson, how are you doing? If you can hear me okay, you can see me all right, put it into the chat. Let me know. Just want to check and make sure that everything is working out properly. Hi, Kala. Yeah, me. Fantastic. Thanks for that, Godson. Hi, Wisdom. How you're doing today? Today, we are here with IronFX on a webinar series on the advanced fundamental analysis. So I hope you use some form of fundamental analysis with your trading. So this will be quite important. We'll give it a couple of minutes before we get started as everyone else streams in. And what I like to do as well is, as you are joining the session, put it into the chat. Let me know where you're joining me from. If you have any questions at any point in time, please feel free to put it into the chat. Let me know. Nigeria. How's it like in Nigeria this time of the year? Fantastic. Botswana. Places I haven't been to, but I would love to go visit someday. Nice. All right, we shall get started shortly. Just bear with me as we give it a minute more before we get going. Quite a number of things to get through today, so I'm quite, and I love looking at fundamentals. So it's really something that I would like to share with you all. Okay. All righty. Hang on. Let's get started. So again, welcome everyone to the IronFX webinar series. Today we are covering the advanced fundamental analysis, basically sharing with you how you could use some form of fundamental analysis together with your overall trading strategy. I do know that quite often when I mention fundamental analysis, a lot of traders kind of glaze over, they're not super interested. Why so is because most traders tend to like looking at the charts more. It's somewhat easier to just load up MT4 or load up a chart and look at the price movements and the candlesticks to try and determine where you should be entering or closing out your trade. But what I do like about fundamentals, and I'll try to convince you about fundamentals, is that it gives you the overall expected direction of where price could be heading, right? The overall expected direction of where price could be heading, just so that, if you're anticipating that price could be heading maybe towards the upside, or it could be going higher. And if the candlesticks and the charts are showing you that it's turning down, then I would, look to sit it out, wait for price to move in alignment with your fundamental analysis to help you get more confluence, right? You have more things. You don't just have the charts and the indicators or the price action showing you that price should be moving towards upside. You also have fundamentals telling you that it should be moving to an upside. Then, that way you get a lot more, a stronger move, possibly a more consistent move for your trade if you're looking to buy. All right. So that's how we would go about with fundamental analysis. That's how I use it as well. I'll tell you more about my trading strategy, but that's why I feel that, despite it being overlooked by a lot of traders, fundamental analysis is quite key to the overall trading, to any overall trading strategy. Okay, so before we get started, a quick disclaimer: the information in this webinar should not be considered as investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. What it means is that as much as I'll be sharing with you how to, adopt fundamental analysis, possibly deploy it into your trading strategy in the longer term, what you should be doing first as we go through this session, two main things to do is, if you have any questions at any point in time, please feel free to put it into the chat. Let me know straight away. I'm watching the chat so I can answer your questions immediately. Don't wait till the end. And then also after this session, don't go trying to analyze it straight away and trying to trade based on fundamental analysis straight away. What I always suggest is, after a session, review the information, test it out, back test it, get a feel of how price moves according to or in alignment with the fundamental analysis. And then after you're testing it out, back testing it, then you would forward test it on a demo account or just placing expectations on the charts, right? So looking at news events, drawing a line, showing where you expect price to go, seeing how price moves in alignment with your analysis or against it. Then you start tweaking your analysis. You can ask more questions. You can reach out to me to find out more. And then once you gain that confidence and the understanding and the confidence, then you would deploy it together with your current trading strategy, right? So it's not really something to replace your current strategy. I always feel that, fundamental analysis or any new parts or parts and parcels of trading that you learn should add on to your current strategy rather than to replace it. Okay, so with that said, quite a number of things to get through. Understanding the economic calendar, right? First of it is understanding economic calendar, news events to watch out for. There's a whole bunch. There's a lot of news events to watch. Or there's a whole bunch of news events that gets released every day, right? But there are only a few to really watch and pay attention to. You don't want to over focus on news events, on every particular news events, because that could end up with you getting too much information or just sitting there waiting for every news event to happen. And then you might just end up not trading, or we say paralysis by analysis, right? So too much information, not always a good thing. There are key news events to pay attention to. And then also understanding how these news events affect the market, whether you see price moving in alignment with based on the news events for the long term or short term, how long to expect price to continue on with the impact of the news. And then also looking at trading economic news events. I'll show you a couple of examples as well. All right. So far, so good. With that quick introduction of myself, my name is Jin Dao. You can all call me Jin. I have been trading for 10 to 15 years now already. The way I trade this is really up my alley, because the way I trade, I first look at fundamentals. I look at the news. I look at what has happened recently, what is coming up. And then based on those two, I develop a bias towards the currency, right? I'll be looking at the news and then determining, okay, this has happened, price should be going up or should be going down. Then looking at the news coming up, okay, if the news comes out this way, price would continue moving higher, or if it comes out the other way, we could see a big reversal towards the downside. So I use a combination of fundamentals first, and then after that, I'll apply the charts to it. All right, so I'll look at fundamentals, get the bias, but then I'll look at the charts to determine when to get into a trade. So I always say that fundamentals gives me the direction, charts give me the timing of when to get into a trade. And then based on the charts, I'll be looking at trend following scenarios. I do most of my trades as a trend following. I do use support resistance levels, some price action, some indicators as well. Okay, so first part, fundamental analysis. With that, let's look at understanding the economic calendar. Okay, there's a whole range of news to be released. Okay, I'll show you one more here first. Okay, so this is in August. We have yen monetary base numbers. We have the Aussie interest rate, or what they call the cash rate here. We have JOLTS job opening. That's the US jobs opening number, and also employment change numbers for New Zealand. So a whole bunch of news events, adding it all together. But what you want to know is that this is done on Forex Factory. You can look for it on Forex Factory, absolutely free to receive information. So I don't pay for any economic information. It's all free to join or free to get information here on Forex Factory. Let me just bring that up. Okay, so you can see it here on Forex Factory. Why is this news calendar or economic calendar so important? Is because it tells you exactly what time, right? It tells you exactly what time the news is happening. And that's very important because before you enter a trade, or rather you don't want to enter a trade and then have a news event that's going to be released in the next couple of minutes. It looks like, it looks really bad because if you enter a trade, a news event could change the direction of price. Okay, something could change and change the direction of price. So what we tend to do is look at the news events or look at the price and then see if there's any news events coming up. If there isn't, great, enter a trade. If there is, wait for the news event to happen, do analysis again, and then look at the charts to determine whether to buy or sell, if it's changed your bias or not. Okay, so the timing of your news release is really important, right? Pay attention to the timing, at what time it happens. I do also have the habit of keeping my own personal trading schedule based on the times, right? You can see that if I bring this up, let me see, how do I do that? Okay, this is Forex Factory here. If you bring this up and I scroll through to next week or the week after, actually, you see that on Monday 26, we all know what's happening there. It's a bank holiday, it's Christmas period. When I see events or when I see non-events like that, I would tend to pay less attention to the markets, right? Take a break, pay less attention to the markets, just because I know that New Zealand, Australia, the Swiss, the Euro, the Pound, the UK, the Canadians, the US, they're all on holiday. Liquidity in the market is going to be low. Volatility is going to be low. It's really no point checking the charts, watching it, trying to find a trade because you know that pretty much everyone else around the world is not trading. So that's how I would plan my own trading day as well. Not just looking at the news events that could happen. I'm looking to see when there are no news events, when market is likely to be quiet with no significant price movements. Okay, so with that, coming back to the, where is it? Let me see. This one. Okay. That was the timing of the news. You can get it on Forex Factory. Let me put it into the chat here for you guys. All right. You can use that to get your news events. Good thing about using such an economic calendar as well is that you not only get the timing of the news, you also get the news event itself, the name of news events. You get the analysis. You see what was the previous data. You see what they expect, right? So the previous and the forecast. And then when the time comes around, the actual data gets released. So you can see here, it's not filled in because the time hasn't reached yet. It was 7:46. You will be waiting for the 8 a.m. news to happen. So the news events or the data for the news will get released as it happens down on the actual here. Okay, so you would be trading actual against the forecast against the previous, right? AFP. So, if you have your actual being greater than your forecast and previous very good, strong number, you expect the currency to strengthen. If your actual is less than your forecast, then I would say you would be expecting price to weaken. Okay, so that one screen, this one screen here on Forex Factory showing you your news, super crucial and important. It tells you the timing. It tells you the news event itself. Okay, it tells you the previous, the forecasted, and the actual data to be released. All right, so this is the first screen or the first site that I have opened every day before I get started with my trades. So you can see here, we got a whole bunch of news, 10-year bonds on Japan, 10-year bonds, building approvals, monetary base, consumer climate, manufacturing PMI, jobs openings, GDT, price index, right? All that put together, it becomes quite confusing. All right, Kalayame, I saw your question. I'll get to that. Just let me get back to that. Okay, so it can get quite confusing. What you want to do is consider how all these news events come together, which ones are going to be more important. And that's why we have this slide here, right? Household events, household news. So this is a range of economic data. You have household news. What we get in household news are employment numbers, right? Employment numbers, consumer spending. We have the job numbers, we have consumer sentiment. All that retail sales data is household. Business would be the PMI numbers, purchasing managers index numbers. All right, and then banks will be the expectations of banks, how they expect prices to be or interest rates to be moving, the overall economic performance of the country. The government will be the GDP. Let me see if I can do this. No, I can't. Okay, so government will be GDP. So I'll show you here. This is PMI. This is GDP. Okay, and then central banks will be interest rates and also inflation. Okay, so you pay attention to interest rates and inflation data on the central banks. The government will pay attention to the GDP numbers. Business will be the PMI numbers to be released. PMI, we have services, we have manufacturing, right? We have services and manufacturing. Household, we have employment, we have spending as an overall. Okay, and what you see here is that there are a lot, based on the dots here, there are a lot of news information on household data, right? Consumer or employment numbers are released weekly for the US, weekly and monthly for the US. We have the consumer spending numbers on a weekly basis. We have a lot of data being released for households. For businesses, it's just one news event, the PMI, the services PMI, the manufacturing PMI. So you have a bit less, right? So you have a bit less information there. Banks, you're looking at the economic projection, right? So again, less info there. Government, even less so. It's just a couple. And then central banks, you have inflation, interest rates, decisions. Okay, so even less so again. Now, let me ask you that. With more news events here all the way down to the least news events. Which do you think is going to be more important? The household data, is this going to be more important, or is the central bank data going to be more important? Based on, you know, the number of news events being very high on a household and news events being very low in central bank, you got it. Great job. Good stuff, yo. Right. So yes, central bank is going to be the most important, although there are less news events. They're more important. They have a bigger impact. They have a bigger impact on the overall economy, and also it applies whatever changes here, whatever changes in this block applies all the way back down again. Right? If they're increasing interest rates, then we could see GDP drop. Right? If they're increasing interest rates, we could see consumer spending drop as well. So there are inflation numbers climbing high. We can see that PMI numbers or economic projection levels might be heading down. So there are bigger impact on central bank data compared to household. All right. So coming back to the timing of the news release and the economic calendar here, when we look at the AFP, so the question there was, you know, about the AFP. What it is A being the actual data being released, F being the forecasted, and P being the previous. So if actual is greater than your forecast and greater than your previous, then you're likely to see price climbing towards the upside, right? How I look at this, or simple way that I would look at this, is that if, say, for example, last month you received $100, okay, and you expect to receive this month $110, but what you actually got was $150. In this case, your actual will be greater than your forecast and your previous. You'll be super happy, you know, and sentiment will be pushing towards upside, hawkish, bullish sentiment, price moving higher. On the flip side, if you had your A being smaller than your F and smaller than your P, then naturally we would say that price will be heading down, because if we flip this around, you get 100, you're expecting 110, but you only got 99, right? Then you'd be negative, you'd be dovish, you see price pushing towards the downside. Now, let's say on the other last scenario, that if your actual is greater than your forecast, but smaller than your previous, what do you think was going to happen there? So just think about it. You know, if you had $100, you're expecting 110, but you got a well, how does that work? That doesn't work. Let's say you got $150. You had 150. You're expecting 110, but you actually got 120. Right? So it's actual was greater than your forecast, but smaller than your previous. What do you think is going to happen here? Will the arrow be pointing towards upside, or will it be pointing towards the downside? What do you think? Upside or downside? Actual, greater than forecast, but less than previous. Good stuff, right? So you will still be looking at price possibly pushing higher. Why so is because you're already expecting 110, but you got more than you expected. Okay. But to preface that, or to put a little bit of a condition to that, it really depends on what happens before, what was happening before. If you always had been at 150 and then now you're at 120, then maybe it would only go up a little bit before turning back down again. So it also determines on what the previous trend was. Okay. Camila, does that answer your Kala Maye? Does that answer your question there about the AFP? Fantastic. Good stuff. All right. So there are also, right? So why a lot of people get confused about prices, they get confused about how things move, right? So give me a second here. Okay. How prices move and which news to pay attention to. It's going to be quite important to pay attention to on the theme of the economic focus. Okay, it's important to pay attention to the theme of economic focus because it's not always the same news. It's not always the same news that you want to pay attention to. In different years, different times, there are different news to pay attention to. Okay, so you can't see it here. This is news events. Oh, I don't know why the color messed up. Okay, this is period. And this is the focus. Okay, so you're going to pay attention to different news events at different times. In 2008, 2009, we had a global financial crisis. 2008, 2009, we had a global financial crisis. At that point, banks were going bankrupt. We had a lot of people losing money. Big corporations were losing money. People were being fired, losing jobs. So the focus then was about employment data and wage growth, right? Employment data and wage growth. A lot of all the other news didn't have too much of a price impact during that period. Markets and traders, analysts will focus on how quickly will people getting back into work and whether they're getting paid the same amount or whether they're getting paid less than before. All right, so that's important there. And then most recently, we all know in 2020, 2021, we had the COVID pandemic. Right, we had a COVID pandemic. What happened at that time? We saw gross domestic product. This is GDP. All right, gross domestic product dropping significantly because as the pandemic was happening, economies were getting closed. Everything was shut down. No one was traveling. No one was spending. GDP dropped, right? GDP dropped significantly. The focus then during those 2 years was GDP going to turn back up? How quickly can it recover? Okay. And now most recently in 2020, it's all the worry about the recession. It's all the worry about the recession. Is it with inflation being sky high, with interest rates now slowly climbing back up, right? Are we heading into a recession? Not just the US, but globally, right? Because pretty much all economies are facing sky high inflation and increasing interest rates. We're seeing a slowdown in economic activity. All of that leads to the risk of a recession. So when it comes down to now in this period, the focus is down to recession, the worries of recession. All the news that I'm paying attention to is about inflation and interest rates. I'm not so concerned about the employment numbers anymore. I'm not so concerned about the GDP numbers. It's all about the inflation and the interest rates. All right. So that gives you a little bit of a snapshot view of the themes. It always changes. You can't just be looking at one set of news and expect to trade based on that or to apply it right across or your journey through your trading, right? Through your trading journey. It always changes based on the theme of the markets, based on what's happening in the world. So there are some key news events to pay attention to watch out for. In general, then you filter it down as situations happen and develop. Okay. So like we we're just talking about inflation data, right? Inflation data, it gets released as CPI. Just this week alone, we've got a whole bunch of CPI data being released, and we've seen huge price movements based on that CPI data. right? So you have core CPI. You have core terrible writing, pardon me. Core CPI, you have CPI month on month, and you'd have CPI quarter on quarter, and then finally CPI year on year. Okay, so you want to pay attention. Look at that. What do you think? Which is going to be more important, month on month, quarter on quarter, or year on year? Which is going to be more important CPI data to pay attention to? Which is going to move prices more significantly? Which CPI data? Year on year, you got it. You guys are fantastic, doing a great job, right? So the year-on-year data definitely would move prices more significantly. Why so? Because it considers a longer period, right? It considers a longer period. It's comparing last year's CPI at that point in time to this year's CPI at the same point in time. So that gives you a longer view, a general view of how inflation growth is going, right? The good thing is that quite often the year-on-year CPI data is being released at almost at the same time as the month-on-month data. Okay, so sometimes people tend to overlook the month-on-month just to focus on the year-on-year. What is the CPI? What's the CPI? The inflation data. Basically, inflation is the measure of change in price level of a basket of goods and services, right? A basket of goods and services. It indicates the change in a cost of living. The target CPI is at 2 to 3%. The target CPI is at 2 to 3%. I can tell you now that the US CPI is at 7.1%, right? The UK data, UK CPI, if I'm not wrong, let me just check that. You can see it just got released today, Wednesday 14th, 3 p.m. GMT +8 just got released at 10.7, right? 10.7 was a 11.1, expected 10.9, came out at 10.7. The US CPI just yesterday, where was it? Just give me a moment, I'll find it for you guys. US CPI, you can see here, just yesterday was 7.7, expected 7.3, was released at 7.1. Okay, so you can see the news events happening this week. So CPI data for the UK right now at 10.7. All right, and what you should notice quite quickly is that the US and the UK CPI is at 7.1 and 10.7 compared to their target of 2 to 3%. So it's multiples above the target level. It's multiples above the target level, which is why we're seeing the central banks increasing interest rates just to try and bring down CPI. So you see that as interest rates increases, typically we should see inflation drop, right? Typically we should see inflation drop. That's the relationship there. Is it researchers and analysts that released the expected results? Okay, so I'll come back to that. So I think what you're meaning is that well, it's not the expected result. Okay, so the results here are being released by the government. So the 10.7 is being released by the Office of National Statistics. So from the UK government on 10.7. So the previous would be what they had last month or last period. The forecast is actually collated from a benchmark of analysts, researchers and analysts. They collect all their expectations, collect all their data, put it together, average it out, and then that's where you get the forecast number. Okay, so can you trust the forecast number? to some extent. You wouldn't say that they're always going to be right. And in fact, I can almost guarantee you that forecast numbers are most often wrong, but it's only how far off they are. All right. So at 11.1, in this case, how I looked at it this afternoon when I was trading, at 11.1, expected 10.9. So I would look at it as, hey, there's an expectation that inflation will slow down. Inflation growth will slow down. And it did slow down. It dropped to 10.7. So it didn't come as a big surprise in this case. I can see that it's slowly moving towards, very slowly moving towards its target of that 2 to 3%. Okay. Makes sense? Hope I answered your question there, Godson. All right, fantastic. So with that, after inflation data, like I was just telling you here, as interest rates increase, we expect inflation to drop. So interest rates decisions comes from the central banks, right? Central banks release their interest rate decision whether to hike rates or to drop rates. We do have a big series of interest rates decision to be released tomorrow, right? Tomorrow. So there's going to be I believe there's going to be huge volatility in the markets for tomorrow. So watch out for that. Central banks hike interest rates to increase the cost of borrowing, right? So imagine now that US interest rates is at 4%. If they look at it, and they might be increasing it to 4.5%. Right now, if you're looking to buy anything suddenly and on a loan in terms of borrowing, then the repayments have gone up from 4% to 4.5%. So it increases the cost of borrowing. And because it increases the cost of borrowing, what happens is that people spend less, right? People spend less, or companies borrow less and spend less. It's better to put your money into the bank and receive a 4% return or 4.5% return compared to trying to trade and trying to make that 4 to 5% returns. So what happens is, as interest rate increases, it slows down on economic activity. It slows down on economic activity. And because of that slowdown, it also slows down the speed of inflation growth, right? It slows down the speed of inflation growth. And that's why it comes back to, as interest rates increases, we're going to see inflation drop. Okay, so right now, as we see inflation in the US 7.1, UK 10.7, still a distance away from the 2 to 3%. What we're going to expect in this case is further interest rate increases to come from the central banks, right? Further interest rate decision or interest rate hikes to come from the central bank. As we look, right, as we talk about here, a slowdown in economic activity. How do we know a slowdown in economic activity happens? Is when we look at the GDP data. When we look at the GDP data, because GDP measures the total value of goods and services produced in an economy, in a country, right? So, so when we look at, possible interest rates hike, right, slowing down economic activity, we see less people or less production, right? Less investments into machineries, less investments into technology, people saving money, spending less. That leads to a drop or a slowdown in the GDP because goods and services, or rather goods, get slowed down. Goods production gets slowed down. And then overall economic activity of the country slows down. Okay. What do we mean by overall economic activity of the country? We could talk about employment numbers, right? Employment numbers would slow down because companies are not spending as much, they're not building as much, they're not selling as much. So they're going to slow down on employing people. and also spending would slow down. Right? Spending would slow down because the less you work, the less money you have, the less you're going to spend. It's going to come down to spending only what you need, not so much on splurging. Okay, so consumer spending is going to drop as well. So that all puts together into a slowdown of the overall economic activity in the country. Makes sense so far, everyone? I mean, we've gone through quite a number of points here. Makes sense? All good? Okay, good. So how do these key news events affect the market? Right? How do these events affect the market? There, we will split it up in between short-term and long to medium-term effects. So what I mean by short-term effects is that it all depends on the existing trend or the pre-trend, right? Say, for example, employment change numbers, retail sales number, purchasing managers index. These will have short-term impact on price. What I mean by that is that, let's say, for example, price has been trending towards the downside. At this point, right? At this point, employment change numbers might be strong. We might see, an increase in employment numbers. What we could see, or what will most likely happen, is we'll see price push towards upside briefly because of the news, because of the good positive employment change number. But then because of the previous trend towards the downside, what we're more likely to see is that it will continue back down again. Similar to retail sales number, you can say push up, turn back down. PMI as well, it's going to push up before turning back down again. However, if let's say your pre-existing trend was towards the downside, and we have employment change numbers, in this case, not a good number, right? In fact, it's bad. Let's say it's a bad, more people are losing their jobs. What we're going to have is, as it drops, we're going to see that drop down, or not backwards. Let me just do that again. Right, we're going to see as price drops, we're going to see the news come out, bad news. We're going to see price drop downwards before continuing on again. Okay, so it all depends on how your not just the news, but also on the previous trend. Okay, so it's not just employment, retail, or PMI, but also the existing trend. With that said, it's actually more interesting, or you're going to see a bigger trading opportunity when you look at medium to longer term effects, right? Medium to longer term effects, which has the potential, this is very important, potential to change or reverse on trend, right? Change or reverse on trend. This, I'll give you the example of this later as a live chart. But in general, gross domestic product, inflation data, interest rate decision, what happens is that you could see price maybe climbing towards upside. And then let's say that they have decided to increase interest rates, and then we're going to see price drop back down. Okay, so we're going to see this could lead to a change or reverse in price. And this drop could happen over the medium to longer term. Okay, so more accurate depiction of this will be, you see price moving to upside. On release of the news, you're going to see price drop, right? And then after that, continue to trend downwards again. Okay, so it's all, these are the three main news events that could cause prices to change or reverse their trend. Okay, I want to show you this inflation data that we just had. So you see here, yesterday, we had the US CPI data, 7.7, expected 7.3, came out at 7.1, right? 7.7, 7.3, 7.1. In this case, although it is a red number, which should signify bad news, it's actually relatively good, but just that as inflation drops, we're going to see possibly smaller scale interest rate increases for the US. Okay, so a little bit of weakness expected as that released on the US CPI data. We're expecting the US dollar to weaken. So with that, you can see here, right? I'll clear out these charts for now. You see here, this was the euro dollar, right? From the 1st of December, has been pushing towards the upside. We saw it trading higher because of that dollar weakness, right? We saw it pushing higher because of that dollar weakness. And then what happened at this point? This was when the news got released. You can see it was released at 9:30 p.m. GMT plus 8. And then it happened here at 9 p.m., right? Because of that dollar weakness, we actually saw the euro dollar go from this 1.0540, we could even say 1.0540 level, shooting upwards within the hour, right? Within the hour, within the hour, it actually went up by how much? That 121 pips, right? It went up by 121 pips within the hour just because of that data release being CPI weaker than expected, weaker than previous. So we're going to see that weaker US dollar. Right, so that was the euro dollar pushing towards the upside because of the weaker dollar. You can see here as well, this is the dollar index. You can see that it was ranging right across. So this is how it can change a potential move, right? A direction. It was ranging right across. On release of the news, it broke lower from this 105 level straight down towards this 103.60 level, right? It went straight down towards 103.60, consolidated before testing the support level again. So quite important there. One more example I'll show you as well is the US yen. Let me just clear that out. This one you can see it's a complete reversal, right? So remember we were talking about how it's potential to change or to reverse trend. You can see here that the US yen on the H1 time frame had been trading higher, right? We see let me just change this a little bit for you guys. Right, we can see that there was a low here, and then it's from a higher low. It's been pushing towards the upside on release of the news at this point, right? Because of that dollar weakness, we actually saw it turn down from this 137.30 level, broke strongly down to reach 134.70, well, 134.66. Bounced, retrace, and then possibly trading lower again. Okay, so this is really that snapshot view of how news could impact on your prices, could reverse trend based on which news you pay attention to. But bear in mind, it also depends on the previous trend, right? The previous trend. If you talk about big news events, it could reverse the previous trend. But what I also say is that if you're looking to test this out or to deploy this into your trading strategy, don't forget to also consider your support and resistance levels, right? Why we saw the US yen come down and test this level. We know we have a key support level there at 133.75. We know that there was also another level there, bit of a consolidation level there. I mean, a refraction level there. And that's why we saw the US yen drop to that support of 135 before consolidating, bouncing back up, and then now looking to trade lower again. Okay, so anticipation here is that we could see the US yen trade lower towards the downside, towards the 133.75 support level, because of that new downward trend, given the CPI data release. Okay. What I'll do next is also just to pre-warn you about what could be happening. You see here at 3 a.m. GMT +8. So I have a couple of new people who have just joined us. Just convert this to your timing. 3 a.m. GMT +8. We do have the US interest rate decision looking to go from a 4 to a 4.5%. So a rate hike expected for the US from 4 to a 4.5. Watch out for that. We could see the US dollar strengthen, right? Weaken first, and then after that strengthen or fluctuate around in high volatility. And then at 4:30, we do have the Swiss National Bank with the interest rate decision, 0.5 to a 1%. Again, another 50 basis point rate hike expected. 8 p.m. tomorrow, GMT +8, Bank of England for the UK expected to increase interest rates from 3 to 3.5. And then lastly, at 9:15, we're looking at the ECB, the European Central Bank, looking to take interest rates higher again from a 2% to a 2.5%, another 50 basis point rate hike. So you see that tomorrow, if you're looking to trade, tomorrow, just be super aware that there are a lot of big news events we're very likely to see price spike up, spike down, high volatility situations, because we have the euro with the big news, we have the pound with the big news, the Swiss franc with the big news, and most of all, the US dollar early tomorrow morning at 3 a.m. GMT +8 with the interest rate decision as well. Okay, so a lot of central bank news for tomorrow. We're going to see, might be, if you're comfortable scalping the market, there might be very good trading opportunities. But if you're not comfortable with it, then intraday opportunities, I think that if you're looking at longer term trades, you might want to, size it down, so that you can move your stop loss a little bit further away, because I think volatility is going to be high. So you don't want to get fluctuated out of your trading position. Okay. So with that said, as we come to the end of the session, is there any further questions? If there are no further questions, also I would like to ask is, now that we've got the snapshot view of how fundamental analysis can add on to your trading strategy, would this be something that you'll be looking to, test it out and to deploy into your own trading? What's my general advice to beginners to FX? I would say start small, be quick to learn, but test it out, try it out. Don't give up. It's a long-term trade, it's long-term journey. So test it out. Find a strategy, or have a strategy that fits to you, not a strategy that you think is going to work, because sometimes good strategies you might not like or might not use because you're not comfortable with it. So find a strategy that fits your own characteristics, your own trading characteristics. Don't give up. It's a long-term game. And lastly, make sure you manage your risk. Okay, I can tell you that in trading FX is not hard to make money, but if you don't manage your risk, it's going to be really hard to try and keep your money. Okay, so make sure risk management is number one, crucial to any beginner or intermediate or expert in FX trading. Don't you have a personal space where we can chat with us? You can reach out. I think that there is the chat room there. I think you ask IronFX about the chat room. You can find out more about joining the chat rooms. Alrighty. So with that said, hope you remember, please trade well, trade safe, big news events coming out. With that, take care now, and I'll see you again. Bye-bye now.
Hello and welcome to another educational video. As part of our technical analysis series, we would like to look at trend lines. A trend line helps technical analysts determine where market prices are heading. A trader using technical analysis will utilize trend lines to identify and confirm market price trends. This is based on the idea that price trends. The trend line is nothing more than a straight line drawn between at least 2 or more points. An uptrend line has a positive slope and it's formed by connected 2 or more low points. In order to have a positive slope, the second low must be higher than the first. Uptrend lines act as support and point out the net demand it's increasing as the price rises. An increasing price combined with increasing demand is very bullish and shows that buyers are determined to buy. If prices remain above the trend line, the uptrend is considered solid. A break below the uptrend line suggests that net demand has diminished and a change in trend could be looming. A downtrend line has a negative slope and is created by connecting 2 or more high points. The second high must be lower than the first for the line to have negative slope. To confirm that the trend line is valid, at least 3 points must be connected. Downtrend lines act as resistance and demonstrate the net supply is increasing as the price drops. A falling price combined with increasing supply is very bearish and shows that sellers are determined to sell. If prices remain below the downtrend line, the downtrend is considered solid. A break above the downtrend line indicates that net supply is falling and that a change of trend could be looming. The trend line becomes more important and more credible as the number of price extremes that can be connected by a single line increases. The validity of a line that connects only to price extreme is questionable. Most often traders can take profits too early. It is best to stay with the trend until it breaks, avoiding the desire to sell too soon because the profit could be higher than originally anticipated. Thank you for watching.
Everyone, my name is Emily and welcome to another educational video. The word Goldilocks is a reference to the popular children's story Goldilocks and the Three Bears. The term is used in finance to describe an economy that is just right with steady growth and normal inflation. It is an ideal economy that is not too hot and not too cold. In other words, it is a Goldilocks economy. In this balanced and healthy economic system, there is full employment, economic stability, and steady growth. The economy is not expanding too much to push inflation too high and not slowing down to enter into recession. A Goldilocks economy is also good for investing and trading. In a growing economy, companies also grow and generate positive earnings, resulting in their shares performing well. Goldilocks economies are temporary in nature because there are boom and bust cycles. While there may be disagreement among economists about what the exact characteristics of a Goldilocks economy are, the basic idea is that there is a balance between growth, employment, and inflation. The ideal conditions for a Goldilocks economy are low unemployment. Unemployment is measured with the unemployment rate, which reflects the number of people willing and able to work but unable to find gainful employment and who have sought work in the past 4 weeks. The Federal Reserve estimates a normal rate to fall between 5% and 6.7%. Another condition for a Goldilocks economy is asset price inflation, which refers to an increase in prices of shares, real estate, derivatives, bonds, and other assets. Low market interest rates and low inflation are also important, as well as a steady gross domestic product. The GDP is the most essential indicator for a Goldilocks economy as it measures the value of all services and goods produced in a country and reflects the health of an economy. For example, a negative GDP in 2 consecutive quarters indicates a recession. On the other hand, a sharp increase in GDP can push prices too high and result in high inflation. An example of the Goldilocks economy is the US economy of the middle to the late 90s, but also the US economy after the bursting of the dot-com bubble between 2004 and 2005. Thank you so much for joining us today, guys. See you soon. Bye-bye.